All right, so in this video, I'm going to talk a little bit about some aspects of current liabilities management, specifically spontaneous liabilities. So let's talk about what spontaneous liabilities are. Spontaneous liabilities are those liabilities which are generated automatically by basically just running the business. And so let's think about some aspects of that. So if I look at like accounts payable, for instance, if I start running my business, I'm gonna have to place orders to my supplier, and I'm generally going to wind up buying on account, which means we got accounts payable. But if I'm also running my business, as soon as I open up my doors, my employees walk in the door, they start doing work. I now owe my employees wages. So now we're going to generate wages payable. And as soon as I sell something and I generate a profit, I owe the government taxes on the profit. We got taxes payable. So significantly, when you start looking at these spontaneous liabilities, I just run the business and I wind up with these liabilities. And that's why they're considered to be spontaneous liabilities. There's no loan officer somewhere really. I don't have to get a bank's approval or financial institution. Basically, I'm just running the business, and these arise. Now, accounts payable, the supplier did have to agree to sell on account to me, but generally speaking, once that decision is made, this is just an ongoing process. As long as I keep paying my bills, they don't typically cut that off necessarily, unless there was a big change in my financial condition, perhaps. So, generally, once they've decided to extend credit, they're extending credit, and I just run the business, and I wind up with the accounts payable. So within that, these kinds of things, specifically, if I just run the business, these spontaneous liabilities arise. And in a way, they can provide spontaneous funding, which helps to pay for some of the current assets that I have discussed in prior videos. Now, if you think about accounts payable is basically considered trade credit. So basically, when I buy something from my supplier and I buy an account, he has extended credit to me, and that's called trade credit. Now, significantly, this is linked to that cash conversion cycle that I talked about in a prior video. Specifically, that if I wait to pay my supplier longer, then I have delayed when I have actually invested my business's money in my accounts receivable and inventory, and that actually shortens my cash conversion cycle. However, if I wait to pay my supplier, then I may wind up missing discounts. And we're going to see here in a moment that can be potentially extremely costly. So ultimately, these kind of concepts are linked back to that cash conversion cycle that I discussed in a prior video. So let's kind of talk a little bit more about that issue with the increasing the amount of accounts payable, maybe by paying my supplier later, and the cost of that. So in a prior video, when talking about receivables, accounts receivable management, and things like that, I talked about the credit terms. So, for example, if you have the standard stereotypical accounting example, 210 net 30, the idea there is if the customer pays within 10 days, they get a 2% discount. And the full amount is due in 30. Okay. So it turns out you can actually use that information to calculate a nominal annual cost. So basically the cost of foregoing that trade credit. So the nominal annual cost of trade credit. And basically what that's telling us is what does this look like if I give up the discount? And to calculate it, what you do is you look at that discount percentage over 100 minus the discount percentage. And basically what that's calculating is it's kind of approaching this from an opportunity cost standpoint. If I pay within 10 days, then basically what's happening is I'm getting a discount. I'm paying a lower fee. If I pay after, then actually I'm going to kind of switch my perspective on this. Instead of viewing this as a discount, I'm going to view it as they're going to penalize me for paying later. So for this first term, what we're going to show is the discount would be the discount amount or discount percentage relative to what I could have paid if I paid in the discount period. So I'm kind of showing it as I could have paid this amount, but then they're going to charge me basically a penalty for paying after the discount period. So I'm kind of recasting this as essentially a penalty for paying late, essentially. And that's basically what it is from an economic standpoint. Then that second term of the nominal annual cost formula is basically looking at, well, how many periods are there in a year that I sort of got out of paying late? So basically what you look at for this is I'm going to look at 365 days in a year, and I'm going to divide it by how many extra days were obtained by paying late. So that's going to be that total credit period, the total length of time that the supplier gave you to pay, minus the discount period that you could have paid in within that period and gotten essentially the lower price. So to see this, let's do a little example. So if we give up the discount when terms are 210 net 30 and pay on day 30. So let's say we were paying on day 10, we were taking the discount. All right, that's fine. What does this look like if I give up that discount when the terms are 210 net 30 and I'm going to pay on day 30 instead of paying on day 10? Well, previously, if I think of it, I was paying, let's say for a $100 item, sticker price $100. Previously, I was paying 98 because I paid within 10 days. I got a $2 discount, 2% discount. So we're going to look at the fact that now the supplier is going to charge me $2 more relative to that 98 that I was paying. So I'm going to have 2 over 100 minus 2, or 2 over 98. So this is going to be a little bit more than 2%. What that's reflecting is relative to what I could have paid, they're now charging me more, $2 more. So I'm viewing it as essentially a penalty relative to what I could have paid. So we're looking at $2 over 98. That's my first term. But then I'm going to look at basically, well, what did I get in exchange for that? Well, I'm paying a penalty. I was paying on day 10. Now I'm going to pay on day 30. So basically, I got an extra 20 days. Well, I'm paying a penalty for 20 days. This second term is basically telling us how many 20-day periods are there in a year. So I take 365 divided by the 30. This is what I'm paying now, minus the 10. This is what I was paying previously and taking the discount. And so basically what I'm going to show here is that's an extra 20 days. I take 365 divided by 20. That tells me how many 20-day periods there are in a year. And so basically what we're doing is we're taking that many 20-day periods in a year, and we're multiplying times essentially the penalty I'm incurring per 20 days. And so it's not actually compounding this, it's just multiplying it. So I take the penalty I'm incurring for missing the discount period, that's the first term, multiply it times how many days I got in exchange, or how many periods there would be with that length of time, sorry. And if you work that out, what you get is basically a nominal annual cost of trade credit of 37.24% in this example. So basically what this is telling us is this is roughly equivalent to borrowing at an annualized rate of 37.24%. Now, if you're looking at it and you're thinking, well, that's horrible, you're absolutely right. And so if you think about this, it would actually be more cost effective for a company to take out a loan that was 12% per year, basically 1% a month, to basically borrow at 1% a month, to have the money to pay within the 10 days to get the 2% less discount, because I'd come out ahead. If I had to, that would actually be better, because I'd wind up paying 1% for 30 days to ultimately save 2% on the purchase price. And so ultimately, these terms, those, that little seemingly innocuous 210 net 30, basically they're providing a strong incentive, a supplier is providing a strong incentive to the customer, pay within the discount period, because it is economically advantageous to do so in most cases. Now, that circles back to that cash conversion cycle that I discussed in a prior video. If I lengthen that payables deferral period and I pay later, it does shorten the cash conversion cycle, which we tend to like. However, if that comes at the expense of discounts, those discounts lost are kind of the equivalent to borrowing at a really expensive rate, as we're seeing here, at least in most cases, and that may not make sense. So what this all kind of translates to is, when would you want to pay as a business in most cases? And the answer to that is day 10 in this example, or in other words, the very end of the discount period. I want to pay on the last day of the discount period, because if I pay on the last day of the discount period, I get to essentially borrow money for free the whole discount period, and I pay the same amount as if I paid immediately. So I pay the same amount as if I paid immediately, but I get to borrow for free for a couple of days, so I like that. When is the absolute worst possible day to pay? The day after the discount period. Because once you get the day after the discount period, you missed all the discounts and you got one measly day to show for it. And so on an annualized basis, that will almost assuredly lead to a horrifically high nominal annual cost basically associated with that transaction. So from that perspective, pretty much businesses that are selling on account are providing a very strong incentive to their customers, pay within that discount period, because it's probably advantageous for you to do so. And it would probably even be more effective for you to borrow somewhere else to make sure you could pay within that period. All right, hopefully this little discussion about spontaneous liabilities has been helpful. Thank you so much for watching, and have a great day.